So welcome everybody to the second session for today, looking at insurtech solutions for inclusive insurance. So let's have a look at the housekeeping issues. So if we can have the next screen, please, to remind everybody. So just a reminder that this session will be recorded, and we really would like to have quite participation from the audience in this panel session. So please use the question and answer function to ask your questions. And you can ask questions throughout the whole panel session, and we'll address most of the questions towards the end of the panel. But it would be good to ask your questions as they arise during the various talks. And we know that technology is not always reliable, so please use the chat function if you have any technical issues. So let's look at the introduction on the next slide for this session. So this session is going to look at regulating insurtech solutions. So we've had a lot of discussion over the last day and a half, looking at practitioners' experiences, and quite a lot of topics that are relevant to insurance supervisors have come up in these discussions. So we'll look in further detail at looking at how we can ensure that our customers are protected in these insurtech solutions. And we also would like to consider how supervisors can support innovation and growth in the market. And thanks very much to Agnes for her talk earlier on today, when she really gave some positive feedback on the experiences of working in the TAG committee, and also from the support from the PIA in Zambia for insurtech solutions. So in this panel, we have quite a variety of experience in inclusive insurance and digital technology, internationally as well as in sub-Saharan Africa. So our first panelist will be Manoji Pandey from the A2II, and he will start the discussion with some insights on what supervisors need to consider when they are regulating and supervising insurtech. Secondly, we have Namakau Ntini from the PIA, and she will share her experiences at the PIA and some of the lessons learned in supervising insurtech solutions over the years. And finally, we have Nichola Beyers from Cenfri, who will give some insights on practically implementing strategies to support innovation at insurance supervisors, and the steps that supervisors can take to support innovative initiatives in their jurisdictions. So without any further ado, I'm going to hand over to Manoji to introduce the considerations that supervisors need to take into account.
Great. Thanks, Janice, and good morning to everyone listening into the webinar. So as Janice mentioned, I'll be starting off the session today by providing you an overview on topics and issues around regulating insurtech solutions, providing you an overview and setting the context for the discussion. Next slide, please. So essentially, regulating for insurtechs or digital insurance solutions for inclusive insurance is about regulating for innovations driven by technology. Now, innovation by definition is anything that is new from as compared to the traditional or what has been existing in a particular market. Hence, in the digital insurance context, it introduces new products and services, new business models, and of course, new market players. Now, by the virtue of this being new and trying to do things in a different manner, they challenge the regulators. They challenge the regulators because such innovations and ideas generally do not fit well with the existing regulatory frameworks that are being used by the regulators. And hence, we see that the regulatory response can be a bit suboptimal. They could either over-regulate or under-regulate. When we think of over-regulating when dealing with innovations, we see too high entry barriers in terms of licensing requirements or prudential requirements for new players, or limited space for new players in the regulation, because by the virtue of being innovative, these new players might not fit into the existing definitions of an agent or a broker, for example. Hence, placing them and regulating them might challenge the regulators per se, and they might overreach. Also, consumer protection issues are something that the regulators are very focused upon, and they can at times take steps which of course is intended to protect the customer's interest, but may hamper regulations. On the other hand, the regulators can also under-regulate. They might have the best of intentions of making sure that they create an enabling environment where the insurtechs or the digital insurance solution providers reach the scale that they need to reach, but they might under-regulate them enough to create risks for the market or the customer. An example that comes to mind is what happened with Ecolife in Zimbabwe a few years ago. Next slide, please. So essentially, when regulating for innovations and in order to avoid suboptimal responses to innovation, there is a balancing act. Now, this balancing act is based on the understanding that regulating for innovations, especially for digital inclusive insurance solutions, is cross-cutting. Not only it requires an understanding of laws and regulations across regulations, but also the tools and regulatory tools and approaches that the regulators use. So digital insurance solutions are essentially built on the foundations of digital financial services, digital payment ecosystems that might exist in a particular market. Hence, when regulating for such insurtech solutions, the regulations have to be in harmony with the banking payments or digital or mobile or e-commerce solutions that might exist, the data protection regulations in a particular geography, over and above what, of course, is for the insurance regulations as well. At the same time, the regulatory tools and approaches that the regulators may need to use would be a bit different. Hence, regulatory sandboxes might be used, encouraging and operating innovation hubs, a testing and learning approach, and a case-by-case approval to be prudent, but at the same time making sure that the environment remains enabling. Hence, it's important to understand that when regulating for innovations, when regulating for insurtech, it is a cross-cutting exercise. Next slide, please. So essentially, in order to have optimal responses from regulators, supervisors need to balance three main considerations. And these three considerations are making sure that the regulatory environment is enabling enough for innovation and scale when it comes to digital solutions, while at the same time ensuring that a fair treatment is provided for the consumers who may have little income and limited insurance and digital financial services awareness, especially when it comes to low-income segments in these markets and in emerging economies. Both these things have to be then balanced with the existing realities of the market itself. The kind of digital awareness might exist in the market, what kind of what quality of digital payment infrastructure is there, access to feature phones, access to data, smartphones, and all of these. So all these have to work in the constraint of the market. And hence, the balance has to be in terms of providing a regulatory environment that promotes innovation while protecting the customer's interest and also works in the constraints of the market that might be there. Next slide, please. So once we know that the regulators are trying to have this balance to optimally regulate insurtech solutions, we would now take a look at the kind of issues that we may see when we think of the digital insurance market per se, especially in emerging economies with a focus on inclusive insurance. One of the things that we see essentially are the slow pace of approvals. Practitioners would essentially talk about that the regulators are not able to keep pace at the same speed at which insurtechs, by the virtue of them being technologically driven, are much more faster in terms of implementing their ideas. Regulators, stretched either in terms of resources or their regulatory capacities, might create a friction and a delay. And that might actually be detrimental for such solutions to reach the kind of impact and scale that they're hoping for. Also, there are regulatory gray areas. As mentioned before, digital insurance solutions are based upon the digital payments infrastructure that might exist in a market. Hence, the regulator has to make sure that there is a degree of harmony in the way regulations evolve. Also, that is also true when it comes to the data protection and consumer protection implications from other digital financial services perspectives as well, and not just for insurance alone. Also, new types of players emerge. We see, that the technological service providers, the app-driven insurance solutions and the like. And also, for example, what we see in Southeast Asia, Grab, which is essentially the Uber of Southeast Asia, claiming to have sold over 100 million micro policies in the course of last year or so. Now, categorizing these players within the existing regulatory frameworks is difficult. Hence, such regulatory gray areas exist when the regulators look at regulating such solutions. Regulatory frameworks are primarily geared towards the traditional models of insurance, whether it comes to inclusive or the traditional businesses per se. So those requirements might be considered anti-digital in a way, like the mode of contracts, whether there needs to be a hard copy or need for wet signatures and the like. Hence, understanding of these issues is important for regulators to making sure that an enabling environment is created for innovation. For these, of course, there is a need for building the capacities of regulators. Entities like us, Access to Insurance Initiative, working with IAIS, the International Association of Insurance Supervisors, look at creating the right kind of knowledge and reference documentation, putting out there for regulators to refer to, workshops and the like. So creating those internal capacities for regulators to understand these aspects is important. What also helps is that the regulators engaging in a regular and ongoing dialogue with the industry, the insurance industry itself, but also the tech regulators and other regulators in the market, in order to create a good flow of information, having a sense of where the market is headed, and making sure that the regulators take care of it. So that is essentially the key things that market development concerns when it comes to regulatory aspects of it is there. Next slide, please. But the second key focus of the regulators also is, as much as creating and enabling the market, is protecting the customer's interest, especially in the digital insurance marketplace. Of course, there are a lot of issues, but the three key things that the regulator is looking at and are looking to improve upon is, of course, the awareness and the consent aspects of when engaging with insurtech solutions or digital insurance solutions. Regulators are working with the industry players in terms of knowing that the client is aware that she has a coverage and essentially what is essentially covered in that coverage. And she actively chooses to be covered. More and more regulations, regulatory focus is on now getting to make sure that the client chooses to opt in onto a particular kind of product. She knows where to go and ask questions in case there is a challenge. So awareness and consent are important consumer protection interest aspects for the regulators. Another thing to look at is, of course, the value these solutions are delivering and, of course, the claims experiences. The coverages have to make sense and the value is being provided. And I guess it is essentially more of an industry phenomena where, the market players are coming up with solutions which are a good fit of the customer requirements. Claims are a moment of truth, and that is true for either just traditional insurance or insurtech solutions, digital insurance solutions, what have you. Microinsurance Network last year, through the landscape studies, identified that the claims ratios for microinsurance solutions for the market studies stood at 21%. Now, while I have not delved into that data in greater detail, but if we could have a breakup of that particular number between the traditional insurance solutions and tech-driven insurance solutions, we'll see that the differential would be higher and that 21% might not exactly be the right reflection of it. So every fair claim that is raised and paid has to happen. And that is what will create the value and the interest of the customer being protected as well. And of course, the customer should also be able to know where she can go to complain in case something goes wrong. Data protection aspects are another factor for consumer protection that is coming up and becoming more relevant. A customer should be able to know where her data is being used and there is her consent for the usage of it, and it needs to be on a need-to-know basis so that no harm is done using a customer's data. Next slide, please. So now looking at all these some of the high-level questions around regulations for innovation when it comes to inclusive insurance solution using technology, insurtechs, digital insurance models. We can share a success story where we look at Ghana as a jurisdiction. Now, Ghana is one of the success stories of microinsurance in general, but also for mobile-driven and technology-driven insurance solutions in particular. Starting in 2010, in 2019, more than 4 million policies existed through mobile insurance solutions in Ghana. And that also has to do with the regulator learning more and more about how these models are working and creating an enabling environment while making sure that the customer's interests are protected. And I would like to highlight three things which essentially tells us about the balancing act that Ghanaian regulators have been able to achieve. Next point, please. And those three things are essentially the market conduct rules that came out in 2017, which were based upon industry consultations and with inputs from the market players, essentially, and also getting the customer's impact. And that provided the regulations on how the market conduct of the players should be in the mobile insurance space, as well as the reporting requirements, etc. It also mandated securing consent of the customer. While initially the players were apprehensive that this might create a greater cost of doing business, but in the long run, the regulators continued with this requirement, and today the customer has to opt in for these particular products, and it has actually worked quite well in the market. At the same time, the regulator has been working with the industry players to making sure that there is a regulatory harmony and nothing untoward that might impact the businesses, the business models that exist have taken into being. A case in point being that there was initially talk by the central bank, I believe, of stopping airtime payments as a means of payment of insurance premiums for mobile insurance. The insurance regulator, in partnership with the industry players, made sure that the central bank and the digital financial services payment regulators kept airtime payment as an insurance premium mode, which has helped the growth of mobile insurance and digital insurance in the market. So the balancing act can be achieved. Next slide, please. So to take away, when regulators look at succeeding at this balancing act between enabling environment, protecting the customer's interest while working in the constraints that might be existing in the market, one has to look at the big picture. It is not just about the regulations, but they also need to understand the supply and demand aspects of it, and the regulatory barriers and opportunities, not just within the insurance space, but also digital financial services, banking services, and the like. And all these interventions regulatory have to be proportionate considering the current market stage, as well as when it also comes to focus on the inclusive segments, the low-income segments. So I will stop here for now and look forward to taking questions going forward. Over to you, Janice. Thank you.
So thank you very much, Manoj. So it's good to hear that the regulators really recognize the potential of insurtech and using digital insurance services. But from what we can see, that there is a huge change in mindsets and areas where supervisors need to develop capacity beyond their core roles. And it's good for, I think, practitioners and for the other regulators to understand what the key concerns are, because everybody is trying to really build a market, and consumer protection is of a concern for everybody. So thank you very much. So let me hand over to Namakau to give you some insights into the experiences of the PIA.
Thank you very much, Janice, and a very good morning to all the participants. It's a pleasure to participate in this seminar, just to talk about really the Zambian experience from a supervisory point of view. I think one of the issues that I must mention is that whatever developments have happened in the market have all taken place against a backdrop of not having any regulations in place. So in short, currently, we don't have any form of regulations in terms of inclusive insurance. I think if you heard from the opening remarks when we started the seminar, we just had our new act passed by Parliament, and we're still waiting for it to be assented so that it becomes law. So basically, it's against that background. Allow me to just take a little walk back into history in terms of an account of where we've started as a country when you look at issues of digital inclusive insurance solutions. So Zambia, like in many African countries, really the aspect of digital inclusive solutions were really running on the backdrop of loyalty products. And this we saw coming on board in the early 2000s. And so one of the issues that definitely gave everybody a good feel is that we could see that the loyalty products were able to achieve significant scale, because within a short space of time, we could see that a lot of customers were actually signed up. But however, we have had a bit of some challenges, because we noted that suddenly when we had over 4 million customers signed up, when we did a comparative with the following period, there was a drop in that. And that came about because of, I think, the Airtel story. I think it's a case study that everybody's well aware of. So we saw that a lot of millions of MNO subscribers were actually lost out as far as the insurance coverage is concerned. And that was really a concern for us as a market, because we are at a stage where we're trying to develop our market. We do have a policy in place to actually develop the whole financial sector. We actually do have a financial sector development strategy as well that is in there, so that we can actually see how we can drive inclusive insurance and insurance in general. Because in the past, we've done surveys in the market, and the growth or uptake of insurance services still remains significantly low when you actually compare them to the other financial sector, especially the banking sector. We had the last Finscope done last year, and from the 2015 one that was done to last year, we just had a very, very small movement. We were sitting at about 3%, and we've just moved up to two decimal places to actually about 4% there, about, sorry, 5%. So you can see that we still have quite a bit to do. And so a product like the Airtel one that actually lost coverage is one that we saw actually brought about a bit of damage in the market, in the sense that confidence was actually lost. And so what are some of the reasons that led to this fallout? It's really, I think, the differences in the strategic decisions between the MNOs, the insurance providers themselves, as well as the technical service providers or the insurtechs that were actually behind this particular product. And like I earlier said, this really left a lot of reputational damage in terms of insurance being an effective tool. And we saw that from the number of complaints that the authority would now get. And the PIA would actually receive a lot of complaints where people felt that they were actually cheated out of this particular product. And we actually had to do a lot of consumer education to try and instill the confidence in that. And so most loyalty products had really some serious consumer communication issues, because if you notice the way the Airtel product is, if you've taken time to actually to look at the case study, it started off by a free premium. In the initial stage, it was a free premium, and then there had to be the next stage where the customers needed to actually opt in. Now, it is at the opt-in stage that we have noted that there wasn't sufficient awareness that was actually given to the customers, because they felt that as long as I continue to top up on my airtime, I'll be able to be covered on this particular product. So when the insurer wanted to now move it into the next phase, a lot of the customers didn't actually then move on and sign up. And of course, there were issues around the agreements, the partnership agreement with the MNO as well, because the MNO also really went into this because they wanted a certain value proposition for themselves. And when they noticed that their value proposition was actually not gaining traction, they didn't seem to support it as well, and hence the fallout that we actually saw. We can go to the next slide. So what are some of the digital offerings that we've had in our market? I think I've already spoken to really the Airtel one, and they did partner with Sanlam, and Microinsure, I think, was the technical service provider that was behind it. We've seen MTN in the market working with a number of insurers, with Sanlam as well as with Hollard. And again, we've seen that a lot of these products, they'll take off, and after some time, they tend to reach their pyramid, and then they'll actually then drop off the market. And again, it goes back to really the way they're actually structured, the way the partnerships are structured. The IO one, I will not speak to it. I think Andrew spoke very well on it yesterday in terms of what is actually happening there, together with Metropolitan in the market. We also have professional insurance that has been selling a lot of their products using the digital platform. Basically, they are relying on the USSD platform, similar to what was shared in the previous presentation. And I know that I don't have Agnes's logo here. I know that MLife is one of those that is also on the market doing a bit of some work. So what are some of the key lessons? We can move to the next slide. The next slide, please. So what are some of the key lessons that we've learned in terms of market development? And I'm glad that the previous presenter actually spoke to this. When you look at the aspect of digital inclusive insurance, I think we all can't argue that it does give an effective scale in terms of reaching our market. And like I alluded to earlier, the Airtel product, we saw that within a short space of time, we had 4 million plus customers that were signed up, including the IO one now that has got over 1 million plus customers. And so we also see that it's important to have a dynamic distribution platform or framework in place. And this is achieved by having the insurer on one hand, an insurtech, and an MNO. And we saw that, we've seen in our market that this has actually worked very well. And from a regulatory point of view, even in the absence of the regulations to deal with the insurtechs and the MNO, we have still supported them as a supervisor from a test and learn approach to try and see how best we can actually learn, so that we can even refine our regulations as we go on. In terms of low touch approach, I remember yesterday, Jeremiah mentioned this, that yes, low touch approach alone is not effective. And I mean, I couldn't agree more with him, because it is very true that when you look at some of the complaints that we receive as a supervisor, persons are always complaining that they are signed up onto a product, and maybe they are, especially when you look at the USSD platform, somebody sometimes doesn't consciously, pay attention to what they are doing. And so when they want to opt out, they come back and say, I can't seem to opt out and I want my money back. I can't seem to get my claim back. So the issues of cooling off period, I think it's important that all those considerations are actually put in place. And this is a matter that we are always addressing, even with the insurers, to ensure that they actually give the customers some element of cooling off period, and they actually engage them, as opposed to just dealing with the digital platform that is actually there. And so we are actually saying that technology, yes, does bring in solutions, but it must be seen as really an enabler and not a silver bullet. And this is where sometimes as a regulator, I mean, if there are regulators on the platform, they will agree with me that sometimes regulators have felt that they are actually rigid and they do not want to support technology. It's because technology should be seen that it is really just there to make distribution easy, but we must not throw away everything else that is necessary to actually give a good service to our customers out there. And so customer centricity still remains very supreme. And by that, we mean products should be appropriate. In other words, the design of the product should be, is this product appropriate for the target market? Is the digital solution the appropriate delivery? Because yes, in as much as the digital solution could be the one that is necessary, but is it appropriate for the different segments of the market? And so service providers need to actually do a lot of market research to actually look at whether the product they're actually putting out there is appropriate. And is it able to generate the value to the customers? Because you may put up a product and you're able to actually give, deliver it through the appropriate channel, but is it giving value? Because one of the things we also noted when we studied the Airtel product was that a number of persons were not even getting value, in the sense that there was a low claims experience. And so when you look at a low claims experience, it means that at the end of the day, the value to the customers may not be there at all, because a number of customers probably didn't even know that they were able to claim at a certain point. And so the other side of things that we need to look at are the aspects of consumer protection. And I'm glad that Manoji actually spoke to that one. One of the key issues that we have seen in our market is that there's limited consumer education. There's very limited awareness. The Finscopes that we've done over the years have actually brought out that consumer education remains one of the key barriers. And so even as we talk about driving inclusive insurance through the digital platforms, I think it's important that we do not forget that it's at the backdrop of that, the only way that we can actually have effective scale and reach is to actually, it's to educate the customers so that they are aware of what they're actually taking up, because a number of them may sign up, but if they don't understand what they're signing up to, that is where you have a situation where a product gains some traction, and within a short period of time, it goes off the market. I think one of the things that we have also learned is that limitations, loyalty product models definitely do have the limitation. I earlier on alluded to the fact that customers would have to see the value in the product, as opposed to just looking at it as a free premium or a free benefit that they'll enjoy, because there's no premium that is attached. So we see that through the awareness, it is important that the models that are actually developed are those that will help the customers be able to see the value in actually signing up, such that within a period of time, customers must know that they need to be weaned off, and they don't have to enjoy the loyalty component of the product. With time, they will need to be weaned off, and that way they'll be able to actually stay onto the product. One of the key issues that is a concern for regulators and for ourselves as a PIA we've seen in the market is really the risks that come with the partnerships. We agree that partnerships are critical in actually driving digital inclusive insurance, but it does pose some risks. And some of the risks that we see is it's important to define the roles. And by defining the roles, we need to know who is doing what and who is paying for what. Because if you don't do that from the outset, then you'll find that there's a challenge. And again, allow me to fall back on the Airtel product. What we saw was that from the outset, the insurer or the underwriter had a backseat to everything. And because the underwriter seemed to have played a backseat role, the MNO is the one that was pushing everything. And we had to step in at some point to say it is important for the customer to actually know that this is the underwriter that is behind it, because for the purpose of consumer protection, they need to know where they can complain in case they have a challenge, and even when they want to have a claim. And we also need to look at who pays for what. In the particular case study that I alluded to, we noted that a lot of it was being front-loaded by the MNO and not the underwriter or the financial service provider. And so in a way, they were sitting in a very, very weak position. And arising from that, we noted that it's important that sustaining motivation of engagement is very important. What is the value proposition for the partners that are in this agreement? If they do not achieve a balance in terms of their value proposition, it is bound to fail, because when you look at the loyalty product that I alluded to, the MNO was really looking at sustaining the subscriber base and growing their subscriber base. So when they look at this product that has come on board, and it is not giving them the much needed traction that they were trying to see, obviously their motivation may not be sustained. And so it's important from the outset to actually do that. It's also important to find the right incentive structure. And by that, I mean, the players have to be very open. And I think the persons that need to really speak to this is the insurers themselves, the underwriters themselves. They need to lay on the table what are the cost structures that are involved, because we've seen that when you look at a cost structure, sometimes the insurer ends up with a very, very small amount of the premium that wouldn't reasonably cover their costs as well as enable them provide a service to their customer. So this is very important and cardinal, that everybody in the partnership must understand what is actually happening. And that way, they'll be able to achieve a win-win situation in terms of a value proposition, because every partner that is there will actually know what they're actually doing. The other important aspect of consumer protection we see, and it's good that we've seen this is a matter that we've looked at as sector regulators. We do have 3 financial sector regulators in Zambia. We have the Central Bank, we have the Securities and Exchange Commission for the capital markets, as well as ourselves as PIA for the insurance and pension sector. And we have collaborated on a number of issues, especially when it comes to digital financial services. And just most recently, we have seen the telecom regulator, or the ICT regulator, coming on board to also bring together all these players, because they have seen the need for us to be able to collaborate if we are to be able to come up with regulations that will actually drive inclusive insurance or financial inclusion as a whole, because the agenda is looking beyond just the insurance sector. And we think that this is a very, very good point. And as PIA, we are quite excited about it, that the telecom regulator is here, and they've come at a point which is very good, because we are now actually looking at developing our regulations around inclusive insurance. The other aspect that is very, very important, and I'm glad that earlier on, the earlier speaker, Manoj, spoke to this, as well as I think some presenters from yesterday's sessions spoke to the aspect of data security. Data security definitely remains a very, very important aspect that we all have to look at as regulators. When you look at an arrangement where the insurer is riding on the client base, for example, of the MNO, when those clients are actually, when the data is accessed by the insurer, are the clients aware that they're actually being signed on onto these products? Are they being given the correct information? Is their data going to be held? How is the data going to be secured? Because we've seen that in the case study that I alluded to again, in terms of the data, you find that the MNO takes control of that, and the insurer now has no control of the data, so that they can engage well with their customer. And so there has to be a balance when you look at the question of who holds the data and who holds what particular data. And that is a very important consideration that we're looking at. And like I earlier alluded to, the MNO regulator is coming on board, and these are some of the considerations that we'll actually be making. And it's very important, because when we look at digital inclusive insurance, for the regulator, one of the primary issues that we look at is the aspect of technology risk management. How are we dealing with the aspect of technology risk? Does the service provider have a robust framework that actually does look at issues of technology risk? What is the governance issues around technology risk? How are they dealing with issues of maintaining cyber resilience? I think that's a very important consideration. And so these are things that we've seen have come up, especially now that we are living in this digital age, and maybe thanks to COVID, if that is a bonus that we can talk about COVID, we have seen that a lot of good developments have actually come up and everybody's coming up, but even the fraudsters are coming on board. And we have seen a number of people actually being defrauded, because people will be asked for their PIN numbers, people will be asked for all sorts of security information. And that is where the awareness part of it comes in. So again, as a regulator, we are throwing it to the service providers. What sort of cyber resilience are they putting in place to actually then protect themselves? Another aspect, obviously, when we look at issues of data security, is what I talked about, the third-party services that they are using. How are they working with their partners in terms of maintaining this data? Is there some oversight of what particular data, who holds what data? And I think that's very important from a consumer protection point of view, because you do not want a situation where one day you wake up and you get a message from somebody that you didn't even think you signed up for. And it's interesting, if I may share this experience. And I remember speaking to a colleague who was saying, well, just as well it has actually happened to you, that has oversight over insurance supervision right now. Because I got this text from a bank, and I know that this bank is working with an insurer, and they were saying, oh, we just wanted to notify you that your premium is overdue. You should have paid it about 2 weeks ago. And I'm thinking, I've never signed up for anything like that. So I immediately got in touch with the insurer, and they quickly got back to me and apologized and said, no, I'm really sorry. It looks like when we were getting the mobile number for the particular customer, when we were capturing the mobile number, it was transposed. So the numbers were transposed and we end up capturing your number, hence what we actually did. So I had a very good feel of what actually customers have out there, and it can be quite frustrating to find that you're getting all these messages. And so data security is a big consideration. And so for service providers as regulators, in as much as we want to support innovation, which is what we have done in the Zambian case, because we really don't have a robust framework for inclusive insurance, but we have one of the emphasis that we want to make is the service providers have to take into account the data security issues. I can move to the next slide. Okay, so what are the current and future considerations? Right now, we do have, I won't talk much about the TAG. I think Shipango spoke about the TAG, and I know Agnes in a wrap-up session will talk about the issues around the TAG and really the takeaways from this seminar. So yes, we did work as PIA with the market to develop what are known as microinsurance principles. And again, it's because we had seen that there was a growing appetite from the market in terms of players wanting to come up to offer products around microinsurance, or what is now known as inclusive insurance. And so we had noted that the enactment of our law was taking quite a long time. So there was need to actually come up with some principles that would guide service providers in terms of development of their products and how they actually need to put out those products to their market. And so we did put out the microinsurance principles, and thanks to the support of all the partners, we worked closely with the TAG to actually get this out. And yes, we do have the good news that we have our law in place. And so yes, finally, we will work on the finalization of the microinsurance regulations. And sometimes, yes, there are some benefits in actually getting things done a little late, because there are a lot of good lessons and best practices that I think Zambia as a market has learned, including the experiences that we've had of inclusive insurance products, as well as those that are running on digital platforms. So it puts us at a very, very good footing to actually then recognize and provide for a framework for digital solutions, as well as recognize the role of the insurtechs and see how best we can run with that. We are also at a stage of looking at enhancing our regulatory sandboxing for digital inclusive insurance solutions. And the authority is currently receiving capacity in this area. We have had CGAP that has come forward to actually give us some capacity building in terms of coming up with regulatory sandboxing. Again, yes, there's always a call that the regulator is always at the back of things. It's really because from an honest point of view, you cannot guess what sort of innovation will be out there. And I think it's really the call for regulators from my point of view is that we just need to be open-minded in terms of the support that we're able to give to the market. And as a market, we have tried to demonstrate that this is achievable, because whatever developments and good stories that you've heard that are coming out of Zambia, a lot of them have actually happened in the absence of a very, sort of dedicated framework. We are also looking at development of dedicated innovation lab for insurtech solution. These are conversations that the market is looking at, being spearheaded by the TAG and with the support of the PIA. And so basically this is where we think we could do. And we've also seen that there's need for collaboration with partners to come up with a dedicated innovation fund. And by this we mean we dedicate a fund where different development partners can actually then support entities that are responsive to digital insurance. And this can be done from many fronts when you look at issues of premium collection, claims administration, and so on. So basically I can take a pause here and take any questions. Thank you.
Thanks very much, Namakau. So we do have a question in the question and answer box, but I think let's save that for after the time when Nichola from Cenfri will give her insights, because I think that all of the panelists might have some insights into some of the issues around partnerships. So let me hand over now to Nichola to give us some insights on some of the practical steps that supervisors can take to support innovations in their markets. Thanks, Nichola.
Hi everyone, thanks Janice, thanks Manoj and Namakau. In the interest of saving everyone's bandwidth, I just want to say hi and have everyone see my face, and then I'm going to switch my video off again if that's all right, just to save our bandwidth. So thanks very much for the conversation so far. I'm happy to be here, and today I'll be talking a bit more about the lessons we've learned so far from the practical experience we've had in providing support to insurance supervisors seeking to support responsible innovation in their markets. Next slide, please. I think we are, so next slide, please. Yes, thank you very much. Sorry, I think sometimes there's a bit of a lag, so we should just have a bit of patience, I guess. So I think Manoj did an excellent job of articulating what's on this slide, which is this trade-off or this balancing act to, on the one hand, support the benefits of innovation, while on the other hand, ensuring that consumers are protected. Historically, insurance supervisors have focused their efforts mostly on prudential soundness in line with their mandates, but more recently, their mandates and objectives have broadened to also increasingly focus on conduct of business, on consumer outcomes, on inclusive insurance, and in some cases on the development of the insurance sector itself. And given that we know that innovation brings both benefits and risks, and this expansion of the mandate and the evolution of the mandate, the regulator's role increasingly has become to proactively consider the trade-offs between ensuring that the regulatory framework and the regulator's actions do not hamper innovation, but rather promote it and facilitate it. And I think Namakau made an excellent point here to say that, you know, technology as a driver of scale has a lot of potential, but it's not a silver bullet. But then, you know, on the other hand, the regulator's duty is still to protect consumers against the risks arising. So at this point, then it becomes crucial to balance the mandate to facilitate the innovation and to develop the market, and with this mandate to protect consumers and the overall stability of the market. And I think at this point, then, you know, supervisors are not necessarily always sure what the best way is to strike this balancing act, or what the tools are that they can leverage to do so. So next slide, please, Gemma. And I think it's against this backdrop then that based on our experience and based on the work that we've done with insurance supervisors and financial sector supervisors in, for example, Uganda and Zimbabwe and in Malawi, we developed this framework that really illustrates the roles of the stakeholders in regulating for responsible innovation. It also illustrates the various tools available, and the slide can get quite dense, which is why it's been broken up a bit into these various parts for the sake of simplicity. I think, yeah, I mean, you can make the animations run, that's fine as well. But let me then just focus you on the top part of the slide, where the two components of regulation for innovation are illustrated. So on the one hand, there's the role of the policymaker in addressing regulation for innovation as an issue. And then on the right-hand side of the slide, we see what the tools available are for the regulator itself. I won't be focusing on the role of the policymaker beyond just saying that it's important to note that the policymaker plays a key role in providing the mandate and the policy direction that actually enables the regulator to regulate for innovation at this point. So the range of tools available can seem quite broad and can seem quite confusing, but I'd like to start off by focusing on the engagement tools, which are at the bottom left-hand side of the slide. So engagement tools, or alternatively proactive communication tools, do not necessarily fall within sort of the traditional regulator's toolbox, but actually this is quite an accessible tool to the regulator that can wield significant power and have far-reaching impact. Important to note, when we say sort of engagement tools and proactive communication, we mean two-way communication between industry, between potential innovators such as fintechs, for example, and the regulator, so that industry can communicate its needs to the regulator, and then so that the regulator can almost gather intelligence and provide ways to support innovation in sort of a more proactive way. And another sort of key feature there is that engagement tools are aimed not only at existing incumbents and not only at insurers and players already operating in the market, but actually also at the potential entrants who could be the source of innovation in future. I will give more sort of practical examples of this as I continue through the presentation, because in our work that we did with the Insurance Regulatory Authority of Uganda, they actually, among their most effective and impactful tools that they implemented were actually these sort of opening new communication channels and closer bilateral engagement with non-industry players. But moving on then to the regulatory and supervisory tools. So the one category which focuses on evolving existing supervisory tools actually entails adjustments to regulatory instruments or supervisory processes. I think most of you will be familiar with proportionality, and Manoj also mentioned it in his presentation, where requirements are set in line with the level of risk posed. And proportionality really is the basis for tiered regulatory requirements. And it's been implemented in many different jurisdictions, and it's been acknowledged by global financial standard setting bodies as well. And examples there, as I mentioned, include sort of tiered licensing and proportionate measures such as reduced KYC requirements for certain transaction limits, or reduced sort of agent qualifications selling certain simpler products, for example. Another tool within the category of existing supervisory tools is flexibility, where changes to regulation itself aren't made, but the regulator actually exercises discretion within the parameters of the existing regulatory framework. Obviously, if the existing regulatory framework does not allow for such discretion, this tool is not appropriate within a particular context. But what is a benefit of flexibility is it actually enables supervisors to learn from the risks related to innovation, so that they can then actually tailor regulation according to their learnings. And examples there include the regulatory sandbox, which I think all of us are familiar with almost as a bit of a buzzword, but which is essentially sort of a controlled environment where innovators can test their products without having to fully comply with regulations. But this all the while with the supervisor carefully monitoring what is the potential impact of the product within the sandbox if it were to be launched within the wider market. The sandbox is just sort of an example of, or fits in though, with the sort of broader test and learn approach, which has been applied for many years, and that go beyond the strict sandbox definition to also include things like letters of no objection, or even leveraging discretion in the product approval process. So again, this is an alternative way of allowing players that don't fall within the current regulatory framework of allowing them into the market, either on a permanent or a semi-permanent basis, but importantly, while still ensuring that there are safeguards and monitoring requirements that are set almost on a case-by-case basis. And then finally, part of this evolving existing supervisory tools then is the idea of a principles-based framework for consumer outcomes. And here, treating customers fairly, TCF, allow regulators to regulate in a more flexible manner that allows consumers to benefit without posing additional risks, because the regulator is forced to think through the outcomes and not just to think at and almost to stop at the risks. So the benefits as well as the risks then need to be carefully considered, and allowing the regulator then to tailor its response on the basis of the principle and not to necessarily have to institute a rule. Great. Then moving on to responding to the new emerging risks, and I think here, Manoj, Namakau, your point on data security is an important one, because while the existing supervisory tools speak to the overarching sort of regulating for innovation framework, the need to put specific regulations in place, or to regulate specific risks that come from these innovations is also often quite important. So in this case, then, to think through what the consequences of the proliferation of data is, to think through what the consequences of, for example, cryptocurrency or algorithms where market conduct is concerned. So again, it's to sort of ensure that these specific issues are addressed within the framework. And then another point that I think, Manoj, you raised as well, is the closing of gaps and the closing of regulatory gray areas where entities are operating in between sort of the mandates of different regulators, or operating, having to comply to requirements that don't correspond to their actual function, or having to acting almost in non-compliance then, which is dangerous not only for the providers and creates uncertainty for the providers, but it also has the potential to sort of be detrimental to consumers themselves. And where that's concerned, introducing new licensing types, increasing the menu of available licenses, or introducing temporary licenses, defining new functions, and having sort of conduct requirements that are tailored to these new functions, all contribute towards closing these gaps. And then finally, the next animation. There we go, great. As a final point then, within this framework, it's important that the policymaker and the regulator work together to track and monitor innovation in a more holistic way. So identifying a broader range of indicators that actually go beyond something like, for example, total premium volumes or total assets and liabilities, to capture insurance market development, and to track progress towards that objective or that mandate in a more holistic way. So ultimately then we see these sort of different categories of tools as being complementary, and it's essential to actually consider a combination of the different tools, and then to monitor using these expanded key innovation indicators to see whether the tools are fit for purpose and whether they need to be adjusted to ensure that the regulatory environment is conducive to innovation while also protecting consumers. Next slide, please. From a very, very high level then, what then happens? How does the regulator choose among the various options? Well, firstly, it's important that the regulator be aware of what the market context looks like. Is there a need to respond to innovation that falls outside the scope of the existing regulatory framework, or outside the scope of the supervisory system? And does the supervisor have the willingness and the mandate to support innovation? The tools themselves need to be relevant to address the actual regulatory barriers faced by innovators in the market, which entails that the supervisor engage with market players to understand what their challenges are. Because in the absence of that sort of engagement, in the absence of ensuring the tools are tailored, the risk is that an expensive intervention or an expensive change is implemented that actually doesn't speak to what the needs of providers and what the needs of the market are. And then finally, very importantly, regulatory capacity determines which tools can feasibly be implemented. And understanding and managing the risks from new technologies can be quite a resource-intensive exercise. And while capacity constraints don't necessarily limit a regulator's ability to implement any of these tools, it's important that the very resource-intensive tools be sort of considered less important. So based on the assessed capacity. Next slide, please. So then to illustrate practically what it is that, what it looks like to implement this framework, I have used here the example of the Insurance Regulatory Authority of Uganda, with whom, in partnership with FSDU and with support from FSD Africa, we conducted a in-depth, rather lengthy process to enable them to fulfill their more recent mandate of market development. So In early 2018, their mandate expanded or was expanded through the new Insurance Act from market soundness and consumer protection to also include market development. And this led to a decision within the IRA to recognize that it needed to update some of its existing supervisory processes. And as part of the process, and I'm not going to take you through the entire process just in the interest of time, one of the first steps and one of the initial engagements was focused on determining the market context and focused on determining what the barriers to innovation within the Ugandan market is. And you can see it here on the slide. What we found is that from an industry perspective, from a market participant perspective, their incentives to innovate and their ability to innovate when we started this process was quite limited. Their need to do so was also limited in the sense that they seemed comfortable serving their current market base and comfortable competing more on compulsory product lines than actually innovating and breaking into new target market segments. From the regulatory side, though, our identification of regulatory barriers actually showed that there weren't that many. It was rather that there was more regulatory uncertainty around certain questions, such as, for example, whether online sales are permitted. The product approval process also seemed to pose quite an issue, and the delays in the product approval process, what it looks like, how it works, what needs to be submitted, those posed issues to market participants and to potential entrants to the markets alike. And then from the regulators' side, again, this issue of capacity and of resources became quite clear at the start of this process. So using the framework that I presented earlier, we came up with a set of recommendations for the IRA, and keeping in mind the implementation considerations, we were able to address and identify 4 focus areas. So if you go to the next slide, please. On the basis of these 4 focus areas, which I'll take you through very quickly, the IRA in Uganda was able to implement and roll out the following sort of key actions. So our first recommendation was for the IRA to increase its available communication channels to both existing industry players and potential new interests to actually focus on engagement and discussion around innovation. So signaling to industry that innovation is one of its priorities, signaling to industry that it is open to wanting to understand what industry's issues are, what their questions are, where the interpretation of regulation is concerned, what the barriers that industry is facing are, is something that is important to the regulator. And one of the ways in which that was done is by actually launching an industry innovation newsletter that is sent out quarterly. And the level of engagement that it actually stimulated with the IRA's website and with the IRA itself has been very encouraging. Then the second key recommendation, which was to increase direct engagement with the fintech sector. And the IRA held an innovation workshop to bring together incumbents and fintechs and innovators within the insurance industry to actually try to kickstart a conversation and to see whether the overlapping areas of interests could actually enable partnerships to form or enable a productive exchange of ideas that could lead to innovative developments, while also, again, signaling the openness of the regulator to innovative developments and to being approached by innovators looking to enter the insurance market. Our third key focus area was to evolve the product approval process. As I mentioned, and as Manoj also mentioned, delays in the product approval process and uncertainty around the product approval process was something that was mentioned as an issue by stakeholders within the sector. So as part of this process, the IRA received training on the IAA, so the International Association of Insurance Supervisors, and the International Actuarial Association's risk assessment tool to actually enable them, or to enable the IRA to form a product approval committee that uses a single comprehensive, objective framework to assess the risks that a new product poses, thereby enhancing the transparency of the process, enabling industry to also understand why or why not a specific product would receive approval, and then ultimately also to help the regulator to think through how to mitigate the potential risks that a product could introduce. And then our final focus area then is actually to adapt regulation and enhance licensing options. And in this case, our recommendation was for the IRA to consider a broader category of licenses to enable greater flexibility. And in doing so, in implementing this recommendation, they decided to implement a regulatory sandbox. I think I will stop here because I realize that we want to get to the Q&A, but please, you're welcome to ask any further questions. I know it's been a bit of a rush.
So thank you very much, Nichola. It's really good to see that there are some practical, there's a very practical framework that supervisors can use to really look at how they can support innovations in their markets. And it's good to hear some of the actions that the IRA in Uganda took to start supporting these innovations. So I think I'd like to start. So please ask your questions in the Q&A function. We still have got quite a bit of time for questions. And I guess as people who are involved in insurtech and providers in the markets, it's always a good opportunity to have a chance to ask the supervisors what they're thinking and to get some input in terms of what supervisors can do or are considering to do to support the market. But I wanted to start with the first question that was asked in the Q&A box. So this is a question really looking at partnerships and looking at maybe the potential of bank assurance partnerships, and then issues of what to do when the bank as the partner does not provide the level of service that is expected for customers. So I think these partnership issues are important for insurtech and digital insurance as well. And there probably are some similarities in these issues, and then maybe a couple of differences because banks are also regulated as financial service providers. So maybe I'll start with Nichola, since Nichola has just finished speaking. Maybe if you can give some insights in terms of issues around managing partnerships and looking at ensuring that the partner provides the level of service that is expected or that customers would expect, and what the regulator might expect as well in terms of consumer protection. Thanks.
Thanks, Janice. Yeah, I think one of the key issues here relates to jurisdiction, right? Relates to mandate, relates to the need for the insurance regulator to coordinate with other regulators to ensure that customers in this instance don't slip between the cracks if, for example, the insurance regulator itself doesn't have a direct mandate or doesn't have the authority to, for example, I don't want to use the word punish, but yes, to punish inappropriate actions by entities falling outside the scope. I think it also makes a difference what the overarching regulatory framework looks like in terms of consumer protection, right? Is there a separate consumer protection entity to which customers can turn under circumstances where their rights or where the service has actually not met their expectations. In terms of, yeah, it's an interesting question though, in terms of the in-house insurance team and the difference that makes, whether that means that the bank will then be in charge of developing the products, or whether that will actually enable innovation, or potentially enable sort of greater reach through banks. Because I think ultimately that's one of the main benefits of bancassurance, right? Is that you use the generally wider reach of banks to gain access and to distribute to more consumers. But ultimately, in the absence of sufficiently meeting customers' needs, that broader footprint can almost work against that outcome, in the sense that trust in insurance and word of mouth where insurance is concerned is very important and is very key. And in many of the markets in sub-Saharan Africa, at least, the reputation of insurance is already not great. So if you have banks who are distributing products that don't actually do what customers expect them to do, it's almost like it's a vicious cycle. So in short, then, I think the part that differs from jurisdiction to jurisdiction is just what is the recourse mechanisms that consumers have, and what are the options that the regulator has in terms of consumer protection.
Great, thanks, Nichola. So I think it's important to consider some of the similarities in terms of the supervisor needs to also liaise with the supervisors of banks and make sure that there's a clear mandate of who is looking after the consumer protection. And then also there needs to be a good support mechanism in terms of protecting consumers generally in a country. Namakau, I don't know if you have any insights in terms of looking at the wider market conduct mandates in terms of the fair treatment of customers, how these issues would fit under that, and then maybe some of your insights from your experiences in terms of what might need to be implemented for a partnership to really work well.
Thank you, Janice. Maybe just to pick up from where Nichola left it, I think what's important is also to first of all, describe what is the characterization of this bank from a regulatory point of view. And I'll really speak to the Zambian scenario, because currently banks are licensed as agents of insurance companies. And so it's very, very important that they then have an agreement with the bank in terms of how they actually conduct themselves. And so from a market conduct point of view, as a regulator, our interest will be, what is this intermediary agreement that the bank has with the insurer, and ultimately who is still responsible for ensuring that the customers actually get a good service. And also in terms of the capacity that the bank must have to be able to deliver or distribute this particular product on behalf of the insurer. So yes, it's a consideration for market conduct, because ultimately the tail end of things is a customer that you want to ensure that they have a fair outcome in the process. And so I still really get back to the question of, it depends on the characterization of this particular, intermediary or the bank itself. What is the role of the bank, and how has regulation defined the bank? And I've just spoken to the Zambian market. I know in some jurisdiction, it could be quite blurred, and that presents a very big problem, because then at any point in time, to what extent does the bank regulator have oversight over this insurance component of the bank's business? And what role are they actually playing when it comes to the matters of insurance? So it can become a very tricky situation, and that's why the characterization of from a regulatory point of view of a bank may be necessary, so that it's understood to what extent then there will have to be who has oversight of the bank over certain aspects of the business, especially as they relate to insurance, and maybe the core business of the bank. That's where the banking regulator comes in. So that's a very important consideration. I think it's really to identify who's this bank as far as regulation is concerned from the insurance supervisor point of view. Thank you.
So thanks, Namakau. I think that, yeah, it is very important to have a clear understanding in terms of the different regulators' responsibilities, and also a clear focus also from the insurer's perspective that that focuses on fair treatment of customers and good service to their customers, any agreements that they may have with their partners, including banks. Naj, I don't know if you have any other insights.
Just a couple of points. One is that, bank assurance remains an important distribution channel. And I think the trend in banking also is that the most of the transactions are now happening outside of the banking premises. They are going more and more digital. So the regulators will also have to then look at how those translate in terms of the experience that the customer would have while dealing with bank assurance products. Essentially, that is one. Second, even in the inclusive insurance context, and here I can bring the example of India, for example. India, I mean, financial inclusion still is being driven to a great extent in terms of, being defined as access to a bank account or access to a mobile money account. Indian government a couple of years ago had actually had this strong drive of opening bank accounts for excluded people, especially amongst the rural areas and low-income segments. And then they have built on top of it that these products generally then through the banca channel, essentially, they have built in simple life and term insurance products, which have enhanced the penetration of insurance services in India by a huge margin, with many millions previously unserved and underserved customers getting access to insurance. So it's also a matter of essentially seeing what the policy perspectives are around this. But yes, more and more, I mean, but yeah, in addition to that, everything that what Namakau and Nichola said before do make sense. So that's my 2 cents on this.
Thanks, Manoj. So I think it's good to bear in mind that some of the questions around bank assurance and maybe how bank assurance has operated in the past might not be the way that bank assurance operates in the future, and that digital platforms and digital services are permeating different types of partnerships, and we need to be considering these issues in other areas as well. So it's good to bear in mind. So we have a second question, and this I think really speaks to how can the insurance regulator play a role in really gaining some understanding about the market's practice in various areas in the industry. So areas around how intermediaries are communicating their products, how claims are being handled, and what distribution channels are working well and what distribution channels are posing challenges. And maybe we could really have a consideration in terms of like what the benefits would be in terms of understanding the practice across the industry in these various areas, and also how the insurance supervisor could learn and use this information in their role as the supervisor. So maybe let's start with Namakau. Maybe you can let us know even if there is some sort of investigation into market practice through the PIA or through the tag, and whether you have gained any helpful insights from these types of initiatives.
Thank you, Janice, and to the person that posed the question. Yes, it's important that all players within the insurance value chain at the end of the day understand what their distinctive roles are, and that ultimately it's a service to the customer that has to be considered. And so in terms of how the intermediaries, for example, if I could pick the first component of it, how the intermediaries are actually communicating the products, again, it goes back to the service provider. How do they want this product to be communicated to their customers? And when you look at the way products are designed and actually marketed, the intermediary really has to market this product in a manner that the service provider would like it to be marketed. And from a regulatory point of view, obviously the considerations around disclosure requirements that they need to adhere to. And I could speak to that as PIA. We did issue sometime last year, we did issue key facts statement guidelines to the market to really just help them in ensuring that they all understand what message they need to take out, whether somebody is operating. And when I speak about intermediary in our market, currently we have the brokers as well as the agents, including the other distribution channels. It's important that the key information is put out to the customer. So there has to be full disclosure from that point of view. In terms of handling of claims, well, again, it goes back to the agreement between the service provider and the intermediary, and then it will be known who can actually discharge the claims, because in some agreements, the intermediary can actually be given the leverage by the service provider to be able to handle and discharge claims, while in some agreements, actually the intermediary's role is really of a courier kind of service, where they receive the claim and then pass it on to the service provider, who then has to make good of the same. In terms of whether there's specific distribution allowed, if specific distribution channels are allowed to continue or be discontinued, again, I think this is where regulators have really the leverage to actually look at a distribution channel that is ineffective, or one that is actually effective. If it doesn't bring out the fair outcomes to consumers, that is why the regulator actually has to step in place to actually deal with that. Yeah. So in terms of having a common ground and bringing the players together, the different segments of pieces of legislation will guide in terms of the different categories of the players in terms of what their role is. And so, yeah, essentially that's it. Thanks.
Thanks, Namakau. So we can definitely see that guidance and regulations from the insurance supervisor do set standards for common practice. But maybe let's have, Manoj, we're running short of time, but let's have one insight in terms of how learning from market practice could help the insurance supervisors in their capacity, in their efforts to try and support.
Sorry, I couldn't hear the last sentence of yours.
To support innovation. Sorry, Manoj.
Market can, so just staying on this particular question is what Namakau was referring to previously. Of course, I mean, more and more regulators are now encouraging, and at least are considering in terms of looking at what kind of market research has gone into a certain kind of products and solutions that are being put in there. So if a good customer profile is available on what kind of targets that the particular product has in there, then there can be a lot of good questions put forward in terms of what kind of communication approaches are being put in there when a particular innovation, an innovative product or a solution or a business model is being tried in the market. But ultimately it has to be, I mean, the proof of the pudding lies in the eating of it. And I guess what I essentially mean to say is that as we move along, if the regulator is doing all it can in terms of providing the enabling environment for these digital models to scale up and reach the millions that we expect them to reach to, and provide the degree of coverage and penetration that exists. They also have to start reflecting sooner than later, and also in terms of the value that they are providing. I would not say that there has to be standards set in terms of what kind of performance needs to be out there, because again, that depends on so many different things. But I think more and more, I think the regulators will start looking into that. If the numbers being reported by the regulators or these business models are not in line of other simple proxies, for example, if a mass insurance product is out there and if its claim ratio doesn't reflect the normal mortality rate of the target group that it is looking to cover up to, then there's something wrong with the product. Either it is not communicating correctly, or either it is not being able to provide the right kind of claim opportunities that might exist or should be there. So I do think that going forward, the regulators would have to come up with ideas in terms of looking at it in terms of the effectiveness of these models and providing and service delivery and value delivery that comes in there. And then on the basis of that, corrective suggestions can be made. And that could be harsh disciplinary actions or more nudging, like where market research and better customer understanding becomes a key part of this, or becomes some kind of a requirement, not necessarily a mandatory requirement, but something that is encouraged, so that if better understanding of the market and the customer segment is shown, better communication approaches and better claims processes which are beneficial from the clients can be put in place. So that would be my answer to it. Thank you.
Thanks, Manoj. So that gives us some insights into how monitoring the market can really help the insurance regulator as well as the providers to understand better value for money, and also issues around where improvements can be made to keep on focusing with customers. So Nichola, maybe you can also just give us a couple of insights, and then we'll close this session.
Thanks, Janice. Yeah, and I think yeah, excellent points made by both of the other panelists around this question. I think from our perspective, looking at the framework and thinking through, what does it look like for the regulator to bring different actors together and to monitor different actors' activities. We see, here is very much a role for the type of proactive engagement tools for the regulator to actually seek answers to these questions from industry and from innovators themselves. So through convening, through newsletters, through surveys, literally trying to reach out and to convey its openness to communication. I think an interesting development as a result of COVID-19, the IRA in Uganda had already implemented the newsletter and then had used it during the COVID-19 hard lockdown period to further communicate with industry. And as part of a different research project, we actually spoke to a number of Ugandan insurance providers who commented on this openness from the regulator, and how even in the face of this crisis, they felt quite supported and communicated to and had more certainty about what it is, what their roles and responsibilities are. So I think it's this sort of two-way communication that actually is applicable across different issues. And it's up to the regulator to determine what its capacity is in terms of the type of intervention that it can actually afford to roll out.
Thanks, Nicholas. So I think that really rounds off the understanding of the importance of the insurance supervisors and the industry working together to try and promote the expansion of the markets and innovation in the markets, and for the insurance supervisor to really understand where the market is and where they want to grow as a market. And I think, just to conclude the session, the comment from Alfie really is around the importance of really understanding what the customer's experience is going to be, and for the regulator to ask the hard questions in terms of where these various partnerships or systems can break down, because we really want to ensure that there is growth in the inclusive insurance markets, and we want to use technology to help support that growth, and we want to maintain confidence in the markets by delivering good insurance solutions that meet customers' needs. So thank you very much for all the questions, and to the three panelists for their insights. There's a lot that insurance supervisors can do to help support the market, and it will be a growing experience, I think, for both providers and the supervisors over time. So thank you very much. And now it remains for me to hand over to Agnes, and she's going to do a wrap-up session of all the key insights from yesterday and today. So I think this will be a very worthwhile and important session for us to really get an overview of the lessons that have been learned over the years, and also the recommendations that the various players have in terms of being successful in this market and looking forward to the future. So thank you very much, Agnes.
Okay, good afternoon. Thank you so much. And welcome to this session, which is really a wrap-up to the webinar. I'll walk us through the slides just to give a summary of what has been discussed over the 2 days, and what are the takeaways that each one of us can go away with, especially from each segment. In terms of the first session, I think we had a webinar which showcased the Zambian context and the trends in inclusive insurance. The session started with an opening discussion from the key stakeholders in Zambia. We had representation from the TAG, who are the Secretariat of Microinsurance Growth in Zambia. And then we also had representation from the PIA, Pensions and Insurance Authority, that is the regulator. And we also had representation from FSD, Financial Sector Deepening, where the CEO gave a presentation. This was a high powered delegation that gave the importance to the seminar and how much they value the efforts that the TAG is doing in spreading insurance in Zambia. The discussions were centered around the experience in the Zambian context as regards its growth, efforts in growth, and also the support that we're getting from our various partners. Statistics from Zambian FinScope study were shared, and growth was noted, though it is slow growth, but we're happy to see that there's still growth. And this is pointing to the potential that there is in this industry as regards growth. You will note also from the session that Zambia is an active contributor to the growth of inclusive insurance in Africa, going by the examples that were given. In line with our webinar, technology has proven to be an enabler of access to insurance, particularly in premium collection, claim administration, and claim payouts. The outbreak of COVID also did show us as an industry in particular that technology and embracing various digital solutions is the key to the future. The next slide, we had a session on models, and these, okay. We had a slide on models, and these highlighted the different insurance models in Africa. The lessons learned were that whatever model is being implemented or utilized in the distribution of insurance, especially a digital means, it needs to take into account the needs of the end users. And also, in particular, they need to engage and identify the various partners in product development, design, and distribution. We noted that if a model is developed one-sided and does not take into account the various aspects, it becomes a challenge in implementation. And also the issue of always recognizing the customer as the one who's going to be the end user, and it should meet their needs and they should be comfortable to utilize it. Further, we noted that from all the models, customers or clients are looking for embedded products, which was a lesson that was emphasized, that whatever products we come up with, whatever model we are using, there's need to remember that embedded products are what the clients are looking for, because they don't want to have many partners or many points of accessing their services. Therefore, the value of insurance needs to be seen from the customer's viewpoint, and also to note that claims payout or claims payment has a dramatic effect on how the end user perceive insurance. Unless they can see the end result of that agreement or that partnership that they've gone into, you'll find that they will never appreciate insurance. Further, the need for digital solutions was highlighted again and again. And from the vision side of things, we noted that in the next 5 years, artificial intelligence will be critical to take these digital inclusive insurance solutions to the next level. And those were the major takeaways from this session. The third session was focusing on distribution and strategies from the practical side of things. And we had 4 of our colleagues sharing their experience. And this was in the distribution of various products besides agriculture. I think they were all centered on the life side of things. The session was thus focusing on distributing various insurance products using digital means. And after testing the different models and strategies that are there, African practitioners have learned valuable lessons, which include to be successful in the microinsurance space, you have to pivot your business model and learn to and listen to your customer base. Despite the model being good or excellent or perfect, unless you are able to listen to your customer, you'll find that it won't work. Intrinsically, the microinsurance industry is tied to the security and public opinion of mobile money platform. However, there's need to develop other digital platforms or apps to reach out to the millions of people. What we noted is that quite a lot of our potential clients are comfortable with the mobiles. They know how to use the phone. They've used it for a number of years. They're comfortable with it. However, we also noted that with that, there's still, despite that, there's still room for the development of other platforms, which can also help us deliver micro insurance. And we also noted that the MNOs are also undergoing their own changes in terms of delivery, in terms of setup, and that also may be a shock to the distribution of micro insurance. Therefore, how do we prepare ourselves going forward? And that is coming up with other digital platforms that can reach the millions, as much as we appreciate what we can still do with the MNOs. We also learned that technology alone is not enough for digital inclusive insurance to work. Human interaction remains key, as customers still require a face-to-face audience, and hence the future development of other digital means, and also to work with other partners. Therefore, we need a lot of interaction, exceptional user experiences for both horizontal and vertical scalability. Under session 4, which was practice and strategies as well, I think this one looked more on the design of digital solutions. It looked at examples of what sort of non-mobile oriented platforms are there in the delivery of digital insurance. And we noted mainly that the focus was on the agricultural experience. And we had the DigiFarm and the ARC share with us. These have developed platforms that they're able to utilize in the business distribution with their clients in the agricultural segment. However, what still the conclusion was that digital solutions are a key catalyst of micro insurance penetration in agriculture, just like in any other sector. And having a strong digital capacity guided by customer needs is a key element in realizing success. Mass adoption of insurance requires continuous sharing, improvement, and more distribution channels, and better claims administration and transparency. We further noted that for microinsurance to grow, there's need for regulation and customer protection, and hence to develop those digital solutions. Under the fifth session, which was regulating insurance tech solutions, the session just before my wrap-up, we're looking at what the regulator are doing in their space and what potential is there to grow the business and how they can push this aspect. We noted that regulators are key to the successful growth of inclusive insurance, and they're also in support of use of digital means to grow micro insurance due to the positive contribution that it brings. And further, they are willing, they're more than willing. I think we saw the willingness and the ability that they have to accomplish this through the various resources at their disposal, including various partnerships. We note that the regulators are really bringing in the front of the government, and this also adds value with them taking an interest in the activities. However, most regulators are still working on regulations, though great strides have been made. We heard this from the various countries that were represented, and in particular, we also heard as to what the current status is in Zambia now, and a bit more as to what happens in Uganda. The aim of regulators of regulations to be developed to ensure that the following aspects are taken care of. And one of them is creating an enabling environment for insurers and other stakeholders to provide microinsurance. And this means through the partnerships with many other stakeholders, but also taking into account partnership with the digital solution providers. We also noted that the regulators are concerned about the customer protection as they look at the insurers partnering with various partners. What sort of partnership agreements are they coming into? Issues of data regulation and the protection are also coming in. And these are the core aspects that the regulators are looking out for and ensuring that they are well put in place to avoid this disadvantaging the customers. So as much as they support partnerships with various digital solution partners. They're saying, can you take care of these things so that they're in place, and at the end of the day, industry and customers are protected. The regulators are also pushing the agenda of education so that the customer is aware and understands the product that they are signing up for in this partnership, in these arrangements, so that at the end of the day, they get value for money for that product is meeting their need. Supervision of market conduct is also something that they are concerned and coming up with regulation so as to ensure that we have sustainable partnerships with the MNOs, bankers or banks, government, and whichever partnerships we go into, the MFIs. A lot of them have shared that from experience, these partnerships would commence quite well and will bring value and will achieve the targets as set out. However, with time, you find that they start losing out, and normally the customers are the ones who are impacted negatively. So therefore, the regulator looking at this aspect and trying to see that whatever market activities are going on, whatever partnerships are coming into place, are taking care of the needs of the customer, and there are those that are long lasting and won't disadvantage the industry. Therefore, the regulators are in support of innovation, and they will support innovative ways and look forward to seeing these things being done and pushing the agenda of inclusive insurance. Therefore, from the discussions that we have had, we can deduce quite a number of conclusions that we'll be able to take away and see how we can push this agenda forward. And this is the fact that the insurers are willing to adopt digital models in the spread of inclusive insurance. And the digital solution providers are open to partnerships, but they need to see value. Customers are willing to transact insurance using digital means, but there is a need for the process to be simple, seamless, and they're also looking for bundled products. Despite digitization, the human element cannot be completely eliminated due to the continuous need of engagement and education. The partnership between insurers and digital solution providers should provide assurance and comfort to the customers. There's still room for a lot of innovation in the usage of digital platform. Ladies and gentlemen, therefore the future looks promising, and there's a lot of gains for everyone to make through digital means of providing inclusive insurance. Finally, on behalf of the TAG Secretariat, that's the Technical Advisory Group of Zambia, the chairperson, and the executive board, and the Zambian community at large, I wish to thank all our speakers for being available. We thank you for taking time to speak to us, to share your experiences, and also to open up so that we could ask you questions and get to understand. I want to believe that all of us have learned one or two things from the interactions with you, and we look forward to interacting with you again at another forum. We also want to thank the participants. Thank you for joining in, and thank you for asking the questions. Thank you for being there to share also your experiences and also to make this webinar worth having. And also to our partners. As TAG, we want to thank our various partners. Some of them were highlighted at the opening of the ceremony that was held yesterday, and others may not have been mentioned, but we're grateful to all our partners who have made this event successful. We know that as TAG, we need a lot of support from various stakeholders, and we are happy that you are helping us push this agenda forward in Zambia. And we look forward to working with you again and again. And thank you so much for being there, and thank you for your support. With that said, I wish to close, officially close this webinar, and wish all of us a lot of success, even as we go out to try out new things. We look forward to hosting you again during another webinar. Thank you.